A single hurricane could bankrupt an entire insurance company, so they made a deal to pass the risk along. The mechanism is simple. An insurance company collects premiums from millions of customers. When a catastrophe strikes, a hurricane, an earthquake, a pandemic, the claims pile up faster than the premiums can cover them. By the 1960s, reinsurance emerged as the solution. A reinsurer is an insurance company that insures other insurance companies. The primary insurer keeps some of the risk. The rest gets transferred upstream. Why does this matter to you? Your car insurance, your home policy, they're all built on this hidden architecture. If your insurer couldn't offload catastrophic risk, they'd either collapse or charge you far more. Reinsurance keeps the entire system solvent. Without it, one bad year bankrupts the company holding your policy. You lose coverage when you need it most. The reinsurance market operates in layers. A primary insurer might retain 10% of risk and cede 90% to a reinsurer. That reinsurer then buys its own reinsurance, called retrocession, spreading the exposure even further. By the time a single claim reaches the top of the chain, it's been divided among dozens of companies across continents. No single entity bears the full weight. The cost of reinsurance varies wildly. After major events, the 2011 Christchurch earthquake, the 2017 Atlantic hurricane season, reinsurance premiums spike. Reinsurers raise prices because their own reserves had been depleted. Primary insurers then pass those costs downstream to you in the form of higher premiums and deductibles. You paid for the last catastrophe before the next one even happened. Reinsurers themselves are sometimes massive. Munich Re, Swiss Re, Berkshire Hathaway, these are among the largest financial institutions on Earth. They employ actuaries, disaster modelers, and statisticians to predict the unpredictable. They bet on the probability that catastrophes won't all happen at once. Most years they're right. When they're wrong, markets shudder. The system has a hidden fragility. Reinsurers concentrate risk geographically. They all model the same hurricane zones, the same fault lines. When a truly catastrophic event strikes, one worse than models predicted, multiple reinsurers fail simultaneously. This happened in 1992 after Hurricane Andrew. The losses exceeded every forecast. Reinsurers lost more that year than they'd earned in the previous decade combined. Since then, the market has evolved. Catastrophe bonds now exist, financial instruments that transfer disaster risk to investment markets. Hedge funds and pension funds now hold pieces of insurance risk they don't fully understand. The chain has grown longer, more abstract. Risk is distributed, but visibility is lost. Each player in the chain knows less about the total exposure than the player before it. What you're witnessing is risk transformation. It's not eliminated, it's moved, divided, obscured. Your premiums subsidize this entire apparatus, the reinsurers, the brokers, the actuaries, the models that never fully capture reality. The system works until it doesn't, and when catastrophe arrives, the bill arrives with it. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to uncover how the invisible infrastructure of consumer economics actually works, because knowing how it's built is the first step to understanding what you're really paying for. This video is for educational and informational purposes only and is not financial advice. Always do your own research.